investors to attract employees, etc. So you'll be hearing some information about that. I welcome all of you to come on down to Catalyst.
He has a magnificent space. He did the right thing for entrepreneurs. He used other people's money. Namely, the furniture people put in all the cubicles, right, and all the furniture for nothing.
Wow.
The leasehold improvements were done by the landlord, who was desperate to get this up and running. Helped me. The coffee place was set up by some coffee entity, and I don't know what else, but he's.
It would have never happened without the partners that we found.
Tom,
so.
Question: do you provide hosting or cloud to those clients, so they have an ability to work on apps and so forth?
Yes.
And store it?
Yes.
in fact, you have a very high speed.
Yeah, we have fiber optic internet and some cloud storage capability. Exactly. Yeah.
Tom, let me introduce Tom McElroy, our interim dean of the business school. And Tom's going to sit here for about 20 minutes to check on me, right?
No. I just had a cancellation, so I like to walk around and join classes and learn what we do and what the experience
Tom is
is like.
incredibly energetic, and we all appreciate it.
Yeah, I just came out of the world of buying hosting and cloud companies.
Yeah.
So
So
very similar projects out in Silicon Valley, like Catalyst.
Yeah,
I'd like to talk to you more.
Billions.
Yeah.
We need to get together.
Yeah.
Good to meet you.
Well, let me get started. For those of you who don't know me, and most of you, when I look around the room, have been in other sessions, but I practiced law as a securities lawyer for 40 years. And I became a full-time professor here almost 6 years ago. I teach entrepreneurial finance, which is what we're talking about here. I teach negotiation, which Tom loves to do. And, and he sat in on one not too long ago. And I do this. So we did this for 2 years. We talked about how to raise capital from angels, and we started with, well, why do angels invest? And we discovered that they invest for the fun of it, not to make a ton of money. They don't want to lose money, which is inconceivable for making early stage investments. You're going to lose a lot of money. But anyway, I'm going to switch this now to what does it mean to be investable as I'm talking about it today. And I'll be talking about this in the future. It's attractive to experienced angel investors. That's who I'm talking about. Why? Because there's a gap in our capital system, if you will, between family, friends, and angels, early angels, and venture capital. Big gap. You've got to bridge part of that gap to ever have a chance of scaling up. And basically, it's, in my view, it's companies that have to raise $500K to $1 million. Until they raise $1 million, in my view, in my experience, they can't even talk to VCs. No point in doing that. Now, once they go beyond $1 million, though, they tend to get beyond angels, that they can't get enough capital from angels. So we're going to talk about that too. But but the next step is typically venture capital funding, and yet I would guess, and Dennis knows better than I because he publishes all this information, we would have not more than 10 companies funded by venture capital firms on a first round basis in the state of Florida in this year. So it's not a source of funding really for a lot of good companies that can get up, running, scale up, and sell out ultimately for $50 to $100 million. If you were to tell VC, my goal is to sell out at $50 to $100 million, they'll walk away. Because that's not what they're doing. But that is what angels do. Angels invest for just that kind of model. So let's start. First, and you may remember this before, there's a whole list of very difficult questions that a person has to ask before they raise capital from, and I'm going to call angels knowledgeable angels. Why? There are wealthy people who are not knowledgeable, and they are dangerous investors. The knowledgeable investors are successful entrepreneurs who've cashed out. They know, and they want in for the fun of it. They want to join others for the fun of it. They can peel off 50K and not worry about it. They're not likely to peel off 100K. They start to worry a little bit about it. But 50K, they won't worry about it. So That's the typical size investment, I'll call it, in the Southeast. It's a regional matter, and in the Silicon Valley, it'd probably be 100K for an angel, okay? But let's go through those questions quickly. So I'll go down them quickly. Are you ready to have investors who expect to increase the value of their investment, not lose their money? That's bizarre. Okay, that and that are incompatible. And keep them informed about the performance of the company and compared to what you predicted. Meet with them at least quarterly and answer hard questions. Take their weekly calls, admit failure, explain why you're changing course. Every company I've ever represented did not succeed on what they started with. Everybody changed course. Not dilute them when you raise more capital. That's a ridiculous position too. And not ask them to invest more money. That's also ridiculous. Come in under budget with your expenses. Well, every business plan that any angel person sees has ridiculous financial projections. And what's ridiculous are the expenses. They'll go down in infinite detail, down to literally hundreds of dollars. And they're ridiculously low. And it's a test. Anybody who's been there, done that, looks at that and says they don't know what they're talking about here. So I tell people, don't give a business plan to angel investors. Give them a business model. We'll talk about it. Just a minute. Exceed your revenue projections. Boy, that would be neat. And many other expectations. In fact, let's keep on going with my other questions here. Can you handle the investor who asks for his or her investment back? I can assure you, if you have 10 investors and one of them at least is going to say, I don't like this deal anymore, I want my money back. Well, that's too bad. They've invested typically in equity, you don't get your money back. Can you accept that annual legal fees far exceed what you projected? And accounting fees far exceed what anybody projects. Can you accept you'll have an accounting department, not a bookkeeper? Because everybody wants numbers. Are you prepared to spend 20 to 30% of your time doing things related to having angel investors that you never had to do before? And this is continuous. There's a lot of hand-holding with angel investors, any investors, so long as you have those investors as shareholders. So once a company starts on capital raising and has the opportunity to raise more and more, the CEO and the CFO spend not less than 50% of their time forever taking care of that whole function. So, have you considered all other sources of funding for growth before raising equity capital? Well, you know, we always say use other people's money. And then we come down, equity capital is the way you should go. You should never borrow at an early stage because you're bound to default. But you can do other things. Dennis is a perfect example. He's used a lot of other people's money to get the catalyst up and running, so I'm proud of you, Dennis. Of course, Dennis has been around for a while, right, Dennis? You've seen it. Can you accept that lenders now will never, note how big that is, fund losses? You can't borrow money from professional investors, but lenders, by banks and others. They don't, and have projections that have losses till the third year. Forget that. That can't happen. They are not in that business. So people waste their time going talking to a bank at that stage. And are you willing to promise to sell the company in 5 years, but not really mean it? Because what happens is, as you go, angels don't tend to have terms in their investment terms that will force you to sell. Venture capitalists do. And we'll talk about that later. But they will put terms in so that you don't promise to sell, but there are terms in there they can economically force you to sell at the end of 5 years, roughly. So, are you convinced that you have to have equity capital to grow and you are willing to deal with all of the above? Those are pretty tough questions. However, there's more. Let me get to the next one. I have to get back here. Sorry. So, if you thought the previous questions were hard, now here are the hard ones. Do you have relationships, direct or indirect, with angel investors? Let me put this on presentation. Come on in. Come on, Gary. Gary's got all the answers to this. He's been through this.
I came in just in time.
What was it?
I was all over the building.
Just-in-time education. Do you have direct or indirect relationship with angel investors? It is, in my opinion, in my experience, impossible to raise money from strangers, from total strangers, and it's dangerous. So you have to pursue relationships, mostly indirect. You know somebody who knows somebody, and every candidate that you talk to, you get a referral from that person and say, can you refer me to other friends of yours that might want to invest? Because if you're going to raise $500,000 in today's environment, you're going to have 10 investors, at least. And to get 10, my formula is you have to talk to 100. Yeah, how can you possibly know 100 angels that invest? You can't. So you have to follow relationships. And here's the other thing about relationships. Relationships transfer trust to you. And that is a very big deal for angels in making investments. Have you prepared potential investors to hear a proposal from you? You know, calling them up and then giving them a half-hour presentation is a failure, a formula for failure. You're not going to get their attention. You should have talked to them for 10 minutes and said this, talk to them for another time, 20 minutes for this, finally give them a little one-page summary of what you're doing, and finally get to, can I give you a presentation? Because every stage of the way, you've got to start building, once again, that relationship. And trying to hit somebody with a so-called business plan and a presentation right up front does not do it. Do you have feedback from several angels that you and your business are interested in? In other words, you got to test the waters. Whenever I have a company that's going to raise capital, and we always propose a term sheet, I say, you better damn well take that term sheet around to some people that are going to give you grief and see how it goes. And often, I would say almost 100% of the time, they come back and say, well, I think we need to reduce the valuation a little bit and a couple other things, but you've got to test the waters. And I always say, it's ideally you would go to an angel investor who you know will not invest. Why waste that time? But anyway, that's not a true test. Although I have another test, which you know about. I have the Randy Fry test. Randy founded Autonomous Technologies out in the Research Park, which made one of the LASIK lasers, and we went public and sold the company for $330 million. Well, Randy's around here. I always say, okay, Davis, why don't you take your pitch to Randy? I have to smile when I say that because I know nobody passes Randy's test. But he is smart as could be, and he gives a lot of good feedback. But nobody passes. So, and they all come back all depressed. So, but anyway.
Does he charge?
No. He likes to do that. Have your advisors told you that angels would be interested? Of course it takes experienced advisors, but people in my business, we tend to know whether or not Mark or Jeremy, of course I already know, I think both they could raise capital. So anyway, would be able to raise capital. Can you confidently say your company can grow in value to 20 to 50 million in 5 years? Well, by the way, financial projections are guesses. It's improper to call them projections. You don't have a basis on which to make projections. They're guesses. I call them goals. If you tell the investors these are our goals, that makes sense. You tell the investor these are our projections we're going to be, that does not make sense. You don't have enough information to be able to say that. But you want to be able to support that with some kind of rationale. Now, angel investors love that size company. To them, it could be a healthy company that can use internally generated cash flow to get there after their investment perhaps are one layer more. They love those kinds of companies. And you absolutely need equity capital to grow to that size. I've talked before, I can take any business and look at a business model for that business and tell you there's a growth rate beyond which that business cannot grow without external capital. Now, you start out with zero, you can grow infinitely from zero. But as soon as you're up to $4 or $5 million and you want to grow by 100% a year, I can assure you in that model, you will need external capital. And it's not going to typically come from borrowing. It's going to have to come in some form of equity. So then you get back to that position. Can you answer all those questions and feel comfortable? This is always a good one. Are there similar companies to yours that have grown rapidly in value? You would say, well, no, I don't want to tell them that because they're going to be my competitors. No, that's a good sign. It validates a market for whatever you might be going after. Do you have the charisma to charm investors? Boy, tough one.
Let me just throw in something as a real current answer to the question.
Speak up, Dennis.
Real current answer to the question, equity capital to grow. We just had a recent sale of a company that many of you know, Code School. And I went to the founders talk with Greg Pollock, which many of you may have gone. And that's the fundamental question right there. And that was that he decided personally for a lot of reasons and for reasons for his company to be acquired. But the choice there was, as Bill said, he would have needed equity capital to grow. And that would have changed, for him personally, it would have changed his role in the company. It would have changed perhaps the corporate culture that he had established, et cetera, et cetera. And he chose not to go down that path, but he would have required that kind of capital in order to grow the company. So just a real world example.
Let me get back. Do you have the charisma to charm investors? I would say 90% of the time is no. Can you develop charisma? No. Can you partner with somebody that has charisma? Yes. And of course, it's dangerous to partner with anybody. It does take charisma. Of course, I've seen some that don't have charisma to raise capital. But capital never comes from angels or any other investor on the merits alone, ever. It takes a serious amount of selling, imparting trust, et cetera, et cetera. And charisma tends to help that a lot. Can you spend 75% of your time raising this a round of capital for 500K? You will spend at least 75% of your time raising capital if you're raising 500K. And can you demonstrate, this is always a big deal, why additional capital will fund growth? It's not you want it to fund it, but why? How will that capital be used to actually fund growth? And it better be 50% of it's going to marketing. I better be that. Because you have to develop revenue as soon as you possibly can. Or increase revenue as soon as you possibly can. Have you prepared the 15-minute pitch? We have our students do this all the time. And they get pretty good at it, Tom. And we have a pitch contest, an elevator pitch contest that's very interesting. They come up with a business and they make a 90-second pitch, what they do. Then we have a business plan / model competition in, I think it's March this year. So, and we have very successful companies have won that business plan contest over the last 5 years or more. And there's a whole session we'll talk about the 15-minute pitch. Do you have a really, really, really good business plan to convince you, not somebody else, you, that you can grow? Good. Don't show it to investors. Summarize it in terms of a business model. The VCs used to have a different term for a business model. They said, don't have a presentation more than 12 slides. Well, that forces you to do a business model, which is a strategic, top-down look at what you're getting ready to do, where the value add you bring, the team can execute, et cetera, et cetera. You don't need a zillion numbers. You certainly don't need 30 or 40 pages to talk about that. So it's really a business model that you're going to want to talk about. Do you have a term sheet to test the waters? We've talked about that. Well, there's even more. Okay, so that was just the beginning of whether or not your company, you, wants to raise angel capital. Now let's go to the big map again.
Bill, question?
Yeah.
This business plan versus business model, when compared to investors that aren't knowledgeable as opposed to those that are, I would think that you could get by with giving an unknowledgeable potential investor plan would be satisfied, but a knowledgeable person might really want more depth.
Well, you've raised an interesting issue.
So how do you deal with
You give a
that?
business model presentation to both, let's use the knowledgeable person, okay? And they still end up asking you for a business plan, but they don't read it. It's a test. Honest to God, it's a test. It's a marketing, part of the marketing process for angels. You got to give it to it, but they don't read it. And frankly, you don't want them to read it because they're going to pick it apart, whereas your business model is usually pretty good. But in other words, that's why I say prepare a business plan, but don't give it to investors. But you may end up having to as part of the marketing process, not part of the convincing process. The business plan does not convince people, it does the opposite. A business model can convince people. Well, what's the attitude of the founders after we went through all this? Well, there has to be a willingness to do what is best for the company as a whole once you have investors. It's got to be. And too many entrepreneurs look at their company that they're giving a favor to the investors to let them invest. Really, really bad attitude. That company will not raise more capital if that ever becomes the attitude. Understands the responsibilities to shareholders. It's a big deal. People don't seem to want to understand that they really do have those kinds of responsibilities. And you've heard this before. Are the founders or the management team coachable? One of the things about coachable is it doesn't mean that you always agree with a coach, because remember, a coach is an advisor. You don't take orders from an advisor. You take suggestions from advisors. And any advisor who keeps saying, well, you're not listening to me, is not good. Because not listening to me is code for you're not doing it my way. A good way. Demonstrates critical thinking. Well, we've been doing that in the business MBA program now for some time, trying to get the students to really dig into something. And it's so easy in all respects to be superficial. One of the ways to be superficial, by the way, is a SWOT chart. Okay? You know, you put the, and people fill those out in about 10 minutes and think that's it. It's ridiculous, but that's not it. They've got to get in. One of the things that's always missing in any kind of presentation right here is give me the exact process that the customer will go through to know about your product and to buy your product. And they can't do it. They say, oh, well, there's a big market out there. I don't care. I want to know about that person or that company, how they're going to make that process and go through the process to buy. And when they can't do it, I'll get to this in a minute, there's a problem. I'll show you what the problem is later. And understands the risks that are going ahead. We always put risk factors in, you know, when you ever see a private placement memorandum list of risks. Well, you better identify the ones that are easily identifiable, or prospective investors will think you don't know what you're doing. There are always serious risks that you've got to say, and then come back and say, here's what we're doing to minimize those. Well, let's go back to, you have to have high opportunity market. You know, there are different ways. You can have a market that's growing. You can have a market that's nascent, just getting ready to grow, but how do you know? You can have a market that's stagnant, but your product would be able to replace things that are in there and have a high growth curve. That's okay, that would work. But it's got to be high opportunity. And it's got to be obvious, or it must be convincing it's high opportunity. Just to say, and any student of mine, whoever says, well, there's a $4 billion market, gets an F. There's no such thing as approaching a $4 billion market. There's such a thing approaching a $10 or $20 million market. There are segments in a $4 billion market. You can't possibly approach them all. So it's a high opportunity. Is there supporting evidence? Well, that's really difficult. You know, you can buy reports. You can spend $20,000 to buy a market study from McKinsey or somebody else on things. And they're pretty good, but it's probably a waste of money. But what other can you do? Well, frankly, if there are some people ahead of you as competitors, they're plowing the market ahead of you. That's usually good news, not bad news. Do you have a significant competitive advantage? It has to be viewed from the customer side, not your side. And we'll get back to how do you ever view things from your customer's viewpoint? One of the things we do in the entrepreneurship class, I don't teach that one right now, but we come up with a business model. Every student, every team has to come up with a business model. And part of the exercise is every week they have to go out and talk to some real potential customers. Every week. Because they keep coming back with feedback, it's always very interesting, that differs from what they thought. And what's interesting in a business model exercise, probably a third of them will go through about that first couple of weeks with that, and they'll say, you know, this is not going to cut it. We need to have a different business. That's exactly what a business model is for, is to get early warning that you're headed towards a disaster here. There's no point in you devoting more time and resources to pick another one. But that happens to you too. The business models are typically in your mind, and that's why what we call pivot. You're getting customer feedback that says there's another opportunity here. It might be closely related to what you have, but that's the opportunity that you should go to. Competition is good. I'll just get over that. Unless the market is sensitive to brand, that's bad, because you're not going to have brand awareness. Well, here's the part. Do founders and management have experience as customers in the market they're going after? As customers, here's why. Once again, that person knows what the customer goes through to make decisions. That's always a mystery, frankly, to those looking in to a company or a process or a problem, as opposed to those who are actually experiencing it. There are always subtle things going on there that will affect how your product or service is viewed. And that's the only way to get it. Now, many companies start up where they've sold to that market. Well, that's a step back a bit, but there must be incredible customer feedback at all times, at the earliest possible stage in developing the business. Is there a team that can execute? There is no such thing as a perfect team. End of story. I mean, even in big companies, there's no such thing as a perfect team. Certainly in entrepreneurial companies, there are always gaps in a team because you can't afford it. You can't afford to bring in a full team of people. But do you have charisma and ability? The founder or CEO, I talked about that. It's really, really, really important. Do you have an experienced marketing strategist? No. Do you have a controller, not a CFO? CFO, by the way, in younger companies, I'll say up to 20 million, 30 million, 50 million. You don't need a CFO. You need a dynamite controller. The CFO is the CEO and the board. That's when you finally need a CFO. CFO is a strategist from a financial standpoint, not, and this, you hate this term, bean counter. Don't ever use that word again, by the way. Okay, but controllers are really, really, really important. They pay the bills, you know, they collect the receivables, they manage the accounting functions so your financials make sense. Do Do you have a product specialist? No. Well, what if you have no team or inadequate team? What then? Almost everybody does, by the way. But you have to demonstrate a willingness to form a team when resources are available. Investors understand that, by the way. They understand. You don't have the resources to have a high-powered marketing person. But if you have resources, you have to have a believable case that you can get one. So, are the founders fully committed to the business? And this is always painful. For outside investors, they're going to invest up to $500K. At least 50% of the net worth of that person should be invested. Now, there are many, frankly, most founders who come to me, that's easy, because they don't have anything to invest in. That's easy. But there are times when they come to me and they have $600,000-700,000 in a 401K. Now, investors ask that question, by the way. Now, you all know, you take money out of 401K, you pay a horrible penalty. But investors are not going to be happy if they're investing $500K in the aggregate and you have that account sitting there and you're investing in zip. But I have that situation all the time.
What about spouses? Did they ever ask about that?
They do, but they do accept that, let's say a spouse has independent wealth, they accept that that's not taxable. They do. I think it's because we all know what that would be.
Bill, this is a little bit in the weeds, but I wondered if a 401K can actually roll over into a fully self-directed IRA. That's a little bit, because if it could be, then there might be no penalty.
Yeah, Ben, I have no clue.
That's something I'll find out.
Yeah, I go into my tax department and say, you have 3 minutes to answer that question. You know what I mean? I don't know the answer.
As I say, you can look at solo 401ks if you haven't done those yet. And I know you can loan up to 50 grand off of those things.
Okay,
So not the full amount, it's just a maximum of 50,000.
That's perfect, thank you.
Yeah, and then there's also ROBs, which are rollover for small business owners, which is really kind of setting up your company with its own 401k.
Yes, perfect.
And that's where you can basically, not get penalized from a tax perspective. So,
Excellent.
yep.
Thanks
Just
so
had this
much.
conversation especially. So, believe
That's great.
Hey, we have an expert.
Sorry.
No problem. Well, business models, I've been
Can I-
talking a lot about.
Can I ask one question based on top of that? If you have a IRA, can you use that as collateral against?
No,
No. No.
I don't
Okay.
like to do that.
no bank can
No.
get to it.
Okay.
So no, let's get out of that one, okay?
Okay.
I don't want to talk about IRAs, 401ks. But it's complicated.
Okay.
And basically, you're going to pay a penalty, in my view, typically. If you do that, and frankly, you ought to do it. Well, business model, we have a whole session on business models, what it means and all that, but it demonstrates strategic sense. It really, it does. And business plans don't. Business plans are horrible. And they follow this format that's horrible. So be careful with 30-page business plans. Once again, I always talk about knowledgeable angels. They don't impress anybody, knowledgeable angels. Sometimes they'll ask for it, but they don't read it. I know. With almost certainty, they don't read it. But sometimes they want it just as a test. Have you gone through that exercise? Well, it depends on a generation gap, by the way. Ben's in the generation where you could easily do business models and get away with it. Over in this section over here. you're in the business plan generation, okay?
The older section.
Yeah. Well, what's the minimum viable product or service? You know, we talked about that, about the lean machine, the lean startup and all that stuff. Too often everybody comes out with a new product. Now, let's say you have a self-sustaining company, but you see an opportunity in the market that's related to yours. Can you come out with a minimal viable product? Because it's attempting to put too many bells and whistles on things before you get it in the hands of customers. It's very tempting. And further, it's tempting to react to a single customer who says, oh, you should have this and this and this, and think that's an input from the market. That's a very dangerous thing. So minimum viable product is bare bones. You've got to be able to show customer has perceives value in the bare bones product. If the customer doesn't see value in the bare bones product, they're not going to see value in the product with bells and whistles. So, and next, is there a plan to raise capital? Well, first of all, is it legal? Someone comes in with a business model plan, says, I'm going to raise $4 million from angels. They're out of my office, goodbye. It's not going to happen. That's not believable. Or they've got this person that came to them for a $25,000 fee that they paid him or her, and they're going to raise this money in Saudi Arabia. They're out of here too. That's not believable, those kinds of things. So whatever the plan is for raising capital, it's going to have to be believable. Let's go back to the $500,000, and let's assume you're going to get 10 investors. Does the first one who puts in $50,000 want the company to be able to use that $50K that in there? No. They're going to lose that money. They want to know either all or a large part of that $500K is raised before their money is used by the company. So we typically put a max min. We say, until a company has $300,000, it can't close. But you better have a plan or a model that says the $300K can actually serve a purpose, or else you're headed down the tube. So max mins do work with investors. Now, the other thing that always happens with max mins, investors say, I'll tell you what, when you have the $300K, come back to me. Then I'll invest. Well, you got to give an incentive to be in the $300K. And that's where I always cover it with warrants. Dennis knows I love warrants. So I say the people that come into $300K get a warrant for every share they buy, every 2 shares they buy, they get a warrant for 1 or something like that, which is an option. It enhances the upside without really downside risk. And that, by the way, investors love warrants too. I can't frankly remember any investor that ever made money on warrants, but they tend to love warrants. So that's a problem with max mins. A max min is to satisfy people that say, I don't want you to use my money until there's at least a minimum amount raised. You got to do that. It's silly to put out an offering or a plan that says you're not doing it. It's irresponsible, frankly. Now, what's the probability of raising capital? Let's say you put out an offering memo for $1 million. And you get up to about $300K. And you say to the $300K people, let's close. We can't seem to raise the $1 million. You've set a trap for yourself. You tried to raise too much capital and want to close with too little. So people that do that, I tell, first of all, raising $1 million in just the Central Florida areas, in my experience, is impossible. You have to go around the country. You follow relationships to get to that level. It used to be you could raise $750K over a weekend, by the way, from doctors. This is 20 years ago or 30 years ago, because they just love to make investments in real estate and everything else, but you can't do that today. And there's no company that's going to raise $1 million in a realistic period of time just focusing on Central Florida. Not going to happen. It's not because there's not capital, it's because there aren't angels there that understand your kind of business.
You sort of answered the question. I know that money exists in this area, certainly. And so the question was going to be, if it's here, why is it not available? There's got to be enough intelligent people in this area to see these potentials.
Well, let's flip it, say, what's the investor? Do angels actually seek out investments? That's a good question. No. They have to come to the angels. No, we haven't talked about angel groups. So.
I'm trying to reconcile your 2 bullet points. What is the probability if you raise from angels? So in this scenario, let's say your business model allows you to break even in a test market with angel investment, but it would take, you would no longer be profitable if you now expand your business to several other markets at the same time, where you would need a much bigger infusion of capital. So you've broken even, but you still now need a lot more money to take your business to the next level. I'm
So
just-
would you like a grade on what you just said? Hey, that's an A.
Okay, I'll take it.
Yeah, okay. Yeah, because there are many, if somebody comes in and says, I want to raise 2 million, I tell them, forget that, you might raise 500K, which means automatically they have to raise it in stages. So, here's the next one. If that raise is not going to take you to cash flow break even, not profitability necessarily, cash flow break even, and many times that's not going to be the case. You better be able to show you're going to achieve some milestones that add real value to what you're headed into. And based on those milestones, you say, we should be able to raise another $500K or $1 million. So there's a risk. And I have a good friend who passed away, was early VC, but he would call this risk squared, because it's a risk of the business itself succeeding, but it's also a risk that the company has to raise money in the future to survive. There's a double risk, if you will, there. And but it is incredibly common. Although in today's market, there are very few young companies trying to do something with some, I'm inventing a new $4 million machine tool. That's a ridiculous statement, okay? But to say I have some apps and some new things for productivity, such as solving the email problem, which is an unbelievable problem, they don't take a lot of capital. They take people, and often if it's software, you can have it done in India if you're able to tolerate the communications issues and all that stuff. So it doesn't take a lot of capital often to get those kinds of companies off the ground. And so in those kinds of companies, 500K may in fact take the company to either profits or cash flow break even. But when that doesn't, then they have to be able to make the case right up front to that 500K that says, we're not going to achieve break even with this money, but we are going to achieve these couple of milestones. And those milestones will be obvious to future investors, including you, that we can raise more money. But you have to also build enough running room to raise the next round, which takes 3 months, minimum, to raise capital. So many wait, and I have this chart that I usually put up of a cliff. They're headed towards the edge of a cliff. They know exactly when they're going to be running out of cash. And their value is up here, and it starts to decline as they get closer and closer to that cliff, because they're giving the investors a hell of a bargaining tool that they know they're going to run out of money. They have to have enough running room to not get to the edge of that cliff before they raise more capital. So, is this overwhelming? Yeah, it is. It's overwhelming. But clearly others have done it. I love to bring in successful entrepreneurs, I'll call it that way, to my entrepreneurial finance class. It's an eye-opener to the students. They're all MBA students, of course. But I also like to bring in people that have had great difficulties, to let them see that, because most of them will have great difficulties. And I've said this before in this kind of group, that frankly, investors like somebody that's had difficulties in the past if they can admit them and say what they learned. It's a hell of a learning curve right there. So it's not necessarily negative to have had a past where you've had I'll call it a disaster. Hey, you get on with it, and investors who know you know what you learned appreciate that. So I know that it's hard to believe, but in my experience, it's true. Now, what we haven't talked about here in terms of investing is how in the world do you find 100 angels, okay, to make pitches to? That is an incredible mystery. Every company that I've worked with where they've raised this amount of capital from angels raised it through relationships. They raised it in Minneapolis, raised it in New York, they raised a piece here, they raised some in Texas. And they followed their relationships. And not a single company I can remember raised all of the capital it needed right from here. Now, go back to your situation. We have a lot of wealthy people, but wealthy people are not investors in young companies. It's wealthy, successful entrepreneurs who are investors. And if they've had a big hit, they certainly have the money to do that. And they typically are pretty selective, but they will make investments. I was at a presentation on, I think it was last Wednesday a week ago, Interlocker Country Club, of a company that has a new device to send seismic waves down through the earth to see whether there's oil there. It was a very interesting deal. But they had a who's who in personal wealth from Winter Park sitting in that room. I told some friends, we could start a whole hedge fund just in this room. And it was bizarre. First, they made a mistake. Don't ever make presentations to large groups of potential investors, ever. Because what happened is, I'll tell you, some of the investors, the well-known people, I could give you names, you'd be stunned, but they ask the stupidest questions. Because they don't know.
One person can dispute it, right?
Yeah, and as soon as one person gets up, I don't like this deal, I know a little bit about this, goodbye. That deal is tainted for all the people sitting in that room, and it's going to happen. So I urge people, don't do it one-on-one. Okay, so anyway, it was an interesting pitch, and they've already gone through $1 million. They've had a successful, whatever you call them, hits or something in Kazakhstan, and they have this big plunger piston that goes boom, boom, and they measure the sound waves coming back. Because the other way is dynamite; they put it down a hole, blow it. And there are also big trucks that vibrate the ground that get all that data too. Anyway, it was an interesting presentation, but what I was stunned by were the stupid questions. The first question is, will my interest be diluted in the future? Well, duh, yes. But the poor presenter didn't want to say yes. Poor presenter ducked the issue. Then somebody else, no, because the new capital is going to come out of their piece, not the company. No, that's a big zero too. And it just went on and on and on with these silly questions where people demonstrated they don't know what in the world they're doing. And they shouldn't have been in that audience. But there were a couple very successful entrepreneurs there. They waited until after, and they asked really good questions, but they didn't ask it publicly. So, of course, I've been pinged on about every hour now. Well, what's your interest? Do you want to invest? No. Well, anyway, but they made a number of gigantic mistakes. Even though they seem to have some very interesting technology there, they have 8 patents issued, which is interesting. Issued patents on that. Well, let's come back to the hard question. How do you find 100 angels? The only way that I ever know is following relationships. And, people are reluctant to refer you to someone else unless they think you are a good deal, right? Because you're putting your reputation on the line with who. If I refer you to Jim, Jim's going to look at me and say, "Why did you send that bad deal to me?" But that's the good thing about it. If I refer somebody to Jim, my trust goes back to the company. Jim, it's really good. And back in the old days, which is pre-crash 2001. I can remember where some CEOs would go up to North Carolina and meet with some paper mill people, and they were literally writing checks as they finished the presentation. That was unbelievable. That doesn't happen today, for instance, but that was unbelievable. And they could raise a lot of money. And of course, they lost it all. So what does make a company investable? I've given you an incredible amount of sort of information to test whether you want to raise capital, whether you should raise capital, whether you can raise capital. There are questions on all of those. if you don't want to raise capital, of course, it's the end of the story. If you should raise capital because you have a growth plan that looks like it has merit, you could use the capital to grow rapidly, that's a should. Then you come down, could you raise capital? And that's where nobody has a way to evaluate that very well. For people like me, I put myself in the shoes of an investor and I say, would I be interested? If so, I think I could work on that deal. I don't invest in young companies anymore, but I have lost a lot of money in young companies. Fortunately, I made some that made up for all those losses. Dennis, right? We've all done that, right? So, where do the relationships come from? When it's a pure startup, and I'm talking to an MBA who's just out of undergraduate school, they don't have any relationships. And if they think they're going to raise a lot of money, they better develop some relationships, and it might take 1-2 years. And they don't think they have the time, but they're not going to raise capital. Now by the way, I've had a couple of people with really successful apps sitting right in these chairs right here, students. And I said, why are you here? Because they made a ton of money on a couple of apps, and they're still in the business of developing apps. Because you can develop apps for typically $20,000 maybe. It's unbelievable. Well, in the future, we're going to talk about a lot of these elements. Yes?
Is part of this discussion because we're in Central Florida, whereas the threshold for investability is different in other places? I mean, you read the news and see the stuff that they throw out money in Boston or Silicon Valley, and it's crazy.
Okay, in my view, and the view of some others who've written about this, it's never the lack of capital. It's the lack of investable companies.
The lack of what?
Investable companies. If we had hundreds of investable companies, we would have all kinds of capital down here looking at it. It doesn't work the other way around. If we bring in capital down here, would we have investable companies? The answer is no. No, not even close. Now,
I can say that, and to dovetail this, but a little more of a nuance, and that is that in some areas of the country, particularly California, you've got a new investment model. So I would say by and large in Central Florida, we have the traditional investment model, which is, as Bill has spoken. There are some investment super angels, Mark Suster, 500 Hats, some tech stars that are happening in Silicon Valley, Austin, and Boston, where the model is you make a lot of small bets. It's called the small bet theory, and you put 50K into 10 companies. Mm-hmm. You double down on the couple reality venture capital available. In fact, the aggregate amount it's still 500K, but the guy's made 10 investments. Now all of a sudden 10 companies have gotten funding. What the press doesn't do, of course, is that 9 of those are going to die within 6 months, and they'll disperse to the one that was successful. But the point is, there's a perception that a lot of companies are getting funded, and temporally it's true. And we don't have that kind of an investment model happening in Central Florida or Florida.
Jeremy, let me go back to that though. If you're in Palo Alto, it's easy to find somebody that'll introduce you to everybody around there that's a billionaire. Okay, that's not true here. That is a problem. Okay, but you see so often the government wants to start a venture fund. That's a joke, and or they want to stimulate venture capital. Come down here thinking, now we have availability of capital. Availability of capital is nationwide. It is not just here. And as I mentioned, every company I can remember I've worked with that raised a significant amount of money from angels did so all over the country. Now, there's another aspect to this, and I joke about this because young companies especially, you have to have capital to raise capital. You have to have like 100K just to last to go make all the presentations and do all that stuff. And so, and then for startup companies, that would typically come from friends and family. But you have to have capital. There is capital. And people try to do it on a shoestring. They're not going to make it. Because if it's true, you're going to follow relationships all over the country. You're going to have a hell of a lot of travel.
Plus the legal and the accounting.
All the legal and accounting that goes on. The moment that you start talking to real knowledgeable investors, you better damn well have your I's dotted and T's crossed from a legal standpoint. Gary.
Having raised money 10 years ago and now trying to raise money again, my perception is that the landscape has changed. I'm not doubting that there isn't the same amount of money available, but I spoke to about 75 people, and I raised the first $1 million in about 7 months. You remember all this. And now I'm having trouble. Now, one thing, just going back to the having a team, I had a team 10 years ago, but my idea wasn't nearly as good. It just wasn't as big as this idea. But now what I'm running into is these same angels that I would present to individually who would write checks are now going to these other groups that are headed up by an advisor. FAN would be an example, Florida Angel Nexus, and they're behaving more like a VC. So it's more difficult, in my perception, to get in front of individual investors who don't seek outside or don't line themselves up with groups that are no longer behaving like angels.
He's raised a good point. I haven't touched on angel groups. There are angel groups, more so today than there were, say, 10 years ago. We have at least one here. Oh, we know we have another one here that invested a lot of money, but and they're one in Naples, Gainesville, Jacksonville. Where else? Dennis knows everything.
In South Florida, New Orleans.
Yeah, New World Angels. When you get a term sheet from, say, New World Angels, it is a VC term sheet. And they'll say something, we'll put in $400K, but you have to raise another $400K from somebody else. And here are the terms. Here's the 12-page term sheet. Boy, that stuff. Yet, what that does is it takes away, you don't have to have a relationship to get in front of them. You have to make presentations ad nauseum. But you get invited if somebody that's in that group thinks it has merit. They typically get you invited to their monthly meeting, and you make a presentation. And then if they are interested, you have to come back the next month, and the next month, and the next month, and they finally get down to a term sheet if they want to. But the problem always is, but wait a second, I'm out here raising $500K, and you're only going to invest $250K. Well, you better damn well be going down another path for that $250K, because now you're going to have to start all over again with somebody else for the remainder of the $250K. Now, angel groups, there are different kinds. One model is where angels get together and they put the money into a fund, and either one individual or a couple of individuals among them make the investment decisions. That's a mini venture fund. We call it a seed fund, probably. Okay. Then the other one is where you have a bunch of angels who meet monthly. They don't put any money in, but when they hear a presentation, they send a pad around, how much do you want to invest? And people literally write down, I'll invest 25K, I'll invest 50K. And they decide whether or not they have enough interest. But in those typical meetings, it only takes one person to get at them and just step up and say, I don't like this deal. It's hard to get through angel groups because they then start a due diligence process that's almost identical to a VC due diligence process. And frankly, very few companies pass a due diligence process.
Yeah, so the problem that Gary has alluded to, it's actually, they're not behaving like VCs because, and there was a very, for all of you thinking about FAN, actually Paul Brinkman wrote a fantastic article in the Orlando Sentinel. FAN has announced they're going to raise a committed capital fund. But in that article, he has a quote in there that says something like, despite many meetings with entrepreneurs, they make very few investments, which was an incredible statement to me in the Orlando Sentinel. But here's the issue. The issue is, speaking to Gary, is that with that kind of a situation, you now have all of these accredited investors, and a typical VC fund has an investment committee. and they have some kind of a supermajority vote typically to invest. And there's always somebody that doesn't think it's a great deal, but if the majority do, you make an investment. With an angel group, one person kills the deal.
Yeah, but
And-
they've taken all those investors in a way out of the market. Like
Yeah,
if I could have talked to those 40 people I presented to individually,
That's
I
not
might
true.
have gotten 4 or 5
No,
investors.
that's not true. Most of those investors are also investing individually.
Okay.
And in fact, some have, despite being a member of FAM.
Okay.
Well, let
So,
me-
no, it's not killing
Well, let
them
me
off.
tell you the Winter Park Angels story. We had a group of very, very prominent people called the Winter Park Angels that met here once a month in a classroom just like this, and they would have like 3 companies present. They made one deal in 4 years. They hired a person to be their so-called manager who would propose term sheets and do due diligence, and that person did it. It was just like a venture capital deal. And the states they're in, they don't pass. You know, they don't pass the due diligence stuff. They always come up with, you know, there's this, this, and this. You've got a shareholder who's unhappy. You've got some options. All these problems sit in young companies that can't be resolved instantly, and they would pick them apart and say, we're not going to invest. So, but angel groups, nevertheless, are a source of capital. And they're changing their mission, and that is to syndicate among several angel groups. And Vendello has been helping that syndication. Now, Vendello is a special case. It's here. And they have raised a fair amount of capital on this, $3 or $4 million. And they are actually making real seed investments. And they're piggybacking on some other groups that are investing too. Any kind of seed fund is really, really good. They can invest $300,000 or $400,000. Okay.
Seed, did you say seed fund?
Yeah, seed fund. Yeah, SEED. And so Vendello, you can see, you watch them. You just do a search and you'll see that they announced their various investments. I think they have 9 companies they've invested in, probably 4 of which they originated this. And I think 2 of those won our business plan competition.
Flexor seats is one of them.
Yeah. But they too operate exactly like a venture capital fund. Why? Well, first of all, they're housed with a venture capital fund. We have a venture capital fund here that manages some state money too, but they only invest in large deals. They're not in business to invest $100K or $200K. So we have them here, and they have made some large investments. So one of the our angel groups a substitute for individual angels? My view is no. My experience says you invest, you approach angel investors individually, you will get a deal done much faster than you ever will with an angel group. Now, why do angels join angel groups? Sort of a mystery. First, angels don't tend to seek out investments, but now it's sort of fun. They like to listen to these presentations and think, and if they decide they're going to invest, it's once again, it's for the fun of it. Okay, so, but they're not there because they're dying to invest. They're there just for the fun of it. Anyway, but the angel investors, most of the Winter Park Angels are not part of it.
Oh, good.
So I think, anecdotally, I think you've run into a lot of people that you would know are part of FAN. But most angels that make, I'll call them frequent investments, don't want it to be known. They don't want you to know. Because they don't want to get deluged with business plans. That's interesting, because the only way they can find good investments is to get a lot of business plans. Right? But they don't want to do that. What they want to do is they want to filter. Somebody, they'll take a business plan and see a company from somebody they trust. And that's the filter. They use other people to sort of filter what's going to come to them. When I was there on Wednesday, I was there for a very wealthy client of mine who's out of town, so I sat in. But, you know, I joke about this all the time with those guys that sitting in that room. You know, your net worth is vacillating every 10 minutes by 50K. So you might as well write a check. That doesn't go over well. But angel groups are a special case, and not very many companies. Well, Vendela has helped, frankly. Vendela has made more investments in their 2 or 3 years of existence than any angel group that I know of. I think that's fair to say. So, but that's because, first of all, is Richard the CEO? Yeah, their CEO is a successful entrepreneur. He's been there. He knows the risks that are associated with that, but he also knows the opportunity because he cashed out really well. And so that's a whole different ballgame, isn't it? Now, Than, is it Mike O'Donnell? Yeah, Mike O'Donnell. He's a successful entrepreneur too, but not in technology, by the way. In lending, I think, or something like that. I don't know, factor. I don't know what it is. But he's a successful entrepreneur. But yeah.
What's your definition of a fundable Central Florida company? When you say there aren't any fundable companies here, like
Investable companies.
Yeah.
Has he been here all the whole time? Definition of investable company.
Well, fundable, yeah.
Well,
There aren't-
this is
yeah.
basically what is the same thing. First, it's going to appeal to angel investors who want to invest. That's the bottom line definition. But that doesn't tell you much to what causes to appeal to angel investors. I'll give you copies of my presentation, but there were 20 or more points that we've talked about that comes to all these things to consider to become investable. But going back to Jeremy, I know with certainty that if we have a number of more investable companies here, capital comes. And capital, frankly, is available elsewhere. You get on an airplane. I mean, it just isn't a big deal to go out to Minneapolis or Atlanta or North Carolina to give pitches. It's not a big deal. Yeah, John.
This is just a basic question. How do you spell Vendela?
Venvello. Venvello. It's
Venvello.
venture velocity, right? Venture velocity. Well, it's Venvello. Venvello.
Okay. Thank you.
And their office is right down the street here.
Oh.
Yeah. And you can go on their website.
Yeah, I wanted to reiterate what Bill had to say with regard to being investable and the team or the CEO. I mean, we put on a number of venture pitch events, as you know, and as Bill said, this is a relationship building, and it's getting the investor in a 3-minute, 5-minute elevator pitch. Here's the concept, and many investors will not be interested, but some will be, and then it's the next level. But the next level is that you're meeting with them and they're getting to know you. And I don't know how many times, and Jason Ruttenberg with Arsenal gave a great presentation here at Rollins, and it's that second meeting where he says, I want to get to know the entrepreneur, and they make decisions right then. Is this the team or the CEO that we want to work with? And then we'll delve into the technology and the
Well,
market
first of all, they don't tell
opportunity.
you they've made the decision.
And they don't tell you that. But that is a decision point about coachability, about et cetera. Jason reiterated it, and I don't know how many times I've heard when I talk to people about after a company has pitched a venture pitch, and you talk to some of the investors that talk to me about why or why not did you not make an investments. We determined that the team is uncoachable, the CEO is not coachable.
Yeah.
That word comes up every time.
Yeah, sure.
So it's really understanding where,
Well-
and so I advise entrepreneurs that having an advisor, and Bill has talked about this, about having somebody as a mentor and understanding your personality and you need somebody looking at you as well to understand and to coach you in terms of, are you the person that's going to lead this company and what you have to do.
Jason and I have talked about this, but it's fair to say, those of us who are in the business, you can spot a company in the first 5 minutes practically, that this has an opportunity, it's got a driver, and now let's figure out all the problems. But that's not fair, but it does happen that way. Now, the idea of a pitch, by the way, is to simply get the investor to say mentally, tell me more. That is the goal of the pitch, of a 10, 15-minute pitch. It is not to close the deal. It's not even close. And people that think they're going to pitch and then get a check, that's a ridiculous thing. So that it's tell me more. Well, then you better be prepared to tell them more. And sit down and do all the selling that goes on. Once you have a couple of investors who've signed up for, let's say in that offering for 500K, oh boy, that all of a sudden, that opens doors a lot. Because you basically say all of a sudden, I have such and such and such and such signed up, they'll close when we raise 300K. Boom. Because all of a sudden, you've got some credibility sitting there of people that know. Now, in every deal that I've ever done with angels, there's at least one angel that understands the business because of past experience. And the other angels rely on that person. So your mission is to find that person. Okay? So, for instance, too many companies, they think they're going to go down to Isleworth and just invite everybody in. Forget that. It's not going to happen. They've got to get introduced to successful entrepreneurs. That's the bottom line, and they better damn well have a really good pitch for that first pitch. And often the first pitch is the 1-minute pitch or the 90-second pitch. But I'll have a session on pitches later on. Well, I'm going to continue on with the elements that we've talked about here, what makes a company investable. Okay?
Appreciate it.
And by the way, I will figure out a way to post these things. I don't know where, but I'll figure out what we're going to do here. I'll get somebody in our IT department to figure out how to post them and let you have them. And we'll be doing this monthly on last Thursday, so I don't know when the next one is. Let's check the calendar. And we changed the time from 7:30 to 8:30. Because our Center for Advanced Entrepreneurship thought we'd attract more people. I'm pleased with certainly what we have here today.
Will they still be announced via email like this one was?
Yes, right. In fact, we need a better way, more frequent emails, I think. But anyway, yes, the answer is yes. But we're going to keep it at 8:30. It's an experiment. I don't know if we'll be able to go back to 7:30, but and I'll announce the topic. I always announce the topic about 4 days before the deal, but I should. But it'll be one of the topics that we went over. Basically, it'll be one of those. So Dennis always harasses me. It gets me to announce a topic.
I just, I don't know how the rest of you guys feel. I really look forward to coming to this group and listening to what you have to share. It's sort of like when you look at the credits for a half-hour TV program, you look at all the people that were involved or making a movie. And this guy has been accumulating all this knowledge all these years, and you come here and you share this with us.
I know, I have these incredible scars.
I mean, I had difficulty absorbing it all, but years ago, but
Well, Walt,
I truly, and I'm not trying to, I was kidding with him earlier. I was expecting Kanye West to jump up on the Oscar stage and say the award goes to the best Rollins professor that teaches entrepreneurship, but that didn't happen, fortunately.
Walt, you're kind. But you brought up, I have to tell a war story before we go away. It's been a long time ago. I don't even, probably at least 20 years ago. A young doctor who was doing his residency at Orange Memorial at the time, it's now Orlando Health, was a physicist undergraduate. And he developed a laser that would melt human tissue into glue so you could close wounds. And it works. Now, it took a lot of different frequencies for different tissues that had to have tunable laser, for some wavelengths. And we raised a lot of money, VCs for this. But what reminded me about scars on the back is one of the things that Orlando Health did. They gave them the use of a warehouse on the railroad tracks right behind the hospital. So it was between the hospital and the railroad tracks down there. And what did he do? He brought in 20-some pigs to that building because pig skin is like human skin. And we had a pig jig. So you put the pig in the jig, you anesthetize the pig, and then they put these cuts on the back of the pig, and then some they staple, others they stitch, others they leave open, others they do the laser to see what would happen. It was fantastic, and we kept raising money, and the smell was so horrible. If you went in there, you came out, you smelled the rest of the day, and it just sort of penetrated your clothes. Well, he would vent that once a night. Well, the next door office was one of the very famous doctors down there who complained loudly, "Hey, what is this smell?" Anyway, we ran into an incredible problem with the Food and Drug Administration. We went through 2 more CEOs. They wanted to have us prove that the energy density of the beam, and the beam would be quite small, was uniform throughout the beam. There was no way to do that. And we couldn't get through the FDA. And we spent a lot of money doing trials and everything for the FDA, only to find that was the problem. So we launched to try to recapture the VCs, their money. We launched into a licensing effort. And sure enough, we found a very large pharmaceutical company in Japan to want a license for Japan, China, all the countries in Asia there. And yeah, they were going to pay us a lot of money, so we were glad to do that. So we were negotiating a license from this company to this company for a year. And we went back and forth easily 8 times on this license. Finally, we get to a license and they say, "This is it, let's sign it. How about if you come over for ceremonial signing?" So anyway, the CEO and I fly to Osaka, and we're invited in. We haven't slept for 24 hours and all that stuff, but we're invited in and into the boardroom, and there are about 8 executives sitting there. That's a whole executive team of this billion-dollar pharmaceutical company, and this is a $2 million deal, by the way. And I'm saying, "Oh God, what is going on here?" Well, I read a book as I was going over it called "The Asian Mindset," and I said, "Oh no, this is not good. This is not good. This thing's going to happen here. Not good." So anyway, first thing they did is they go like this with their cars, and you have to do that. And then they did this, and they gave us really nice gifts, eelskin wallets, as I recall. And I said, "Oh, geez, we don't have gifts." Well, the CEO reaches into a brown paper bag, wants to go, and he pulls out these silly watches you see advertised on the airplanes with the logo on them. Cost like $3 each. He passes those watches out.
Oh my goodness.
Anyway, so here we are. We're invited over to the lawyer's office, which is about 2 blocks away. And we sit down, "Okay, when are we going to sign?" "Oh, well, we need to talk." 10 days later, we had to renegotiate the whole damn agreement from start. It was unbelievable. And yet that book told me that was going to happen, by the way. I remember going over, oh no. It's no good. But anyway, so we get ready to sign. And we go over at like 10 o'clock in the morning to the lawyer's office. We're going to walk over to, and he said, "Well, there's been a little delay. Well, we're going to have to wait for a bit." Well, it turned out the SEC, the equivalent of the SEC in Japan, had just taken out the whole management team in cuffs for accounting fraud, and they were carrying boxes out. There were just box after box after box coming out of this place. But somehow he found somebody to sign the agreement for us, and we were off. But that was, it reminded me when I said I had scars on my back. You should have seen those pigs. Anyway, we gave the pigs to some pig farm in a pub.
You want the rest of the story?
Yeah.
That warehouse is now Uncle Bob's Barbecue.
Okay, well, they probably used our pigs.
Well, you know, it's interesting that you mentioned pigs because there's a place up in Tennessee where they do study the degradation of bodies, and that's what they do is they throw pigs out there and watch them deteriorate, and they are able to determine how long a human body
I've
been
read about
someplace
that, yeah.
because of the.
It's for forensics purposes.
Yes,
Yeah.
yes.
By the way, that laser was patented. The patent is expired by now, and they're still experimenting. It does, in fact, work. It's very interesting.
Isn't it amazing?
Here's the
It works,
here's the other
but
problem.
there are times-
Once they did find it, they could do the energy. Now the problem is you gotta bring it across in a steady speed. You can't let it dwell too long on one spot.
Looks like welding.
Yeah, so what they have to do now, and I know somebody's working on it, is a robotic deal, so they can just, and it works. It's unreal, really a neat deal. Because skin is protein, and it actually turns into glue. And it doesn't burn, it melts.
I don't know if anybody read this, which I thought was pretty interesting. They've been able to take a boiled egg and reverse the process. So you've taken an egg, you've hard-boiled it, you've obviously changed the structure of the protein, and they're now able to reverse that back.
Well, I think you need to put your hat on here. That sounds a little far-fetched, but that's okay, you read about it.
He shook his head there, no.
Well, thank you, ladies and gentlemen, for coming. And we'll get an announcement out about next time, and we'll have the topic announced.
Yeah.
Thank you.